Hello, everyone. Welcome. It's my pleasure to present our economic and market update and year-end proactive tax planning workshop here. And we're going to go into some election analysis as well. So, looking forward to having you here today. And please reach out if you have any comments or questions. So we will kind of get started. I always like to start off with this knowledge is power, right? At our firm, we partner with clients. We believe an educated client is our best client. While we'll always try our best to help you, when it comes to our finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that we can to help them make an informed decision. So our agenda today is very straightforward. We'll have an economic and market update. We'll go into some post-election updates and kind of projections and some proactive tax planning to close out the year. Our purpose is to educate and empower clients to realize their dreams through consistent improvement of proactive planning and strategic advice. Here's some, our founder, Gary Pendleton, myself, Gray Pendleton, Diane Layton, and Brenda Santer. All of us are very happy to serve our clients and look forward to working with y'all each and every day. We have nearly 50 years of history here. Last year, we formed our own RIA firm, so it's been a big transition year. Since then, this year, we've done some major technology upgrades, front of house and back of house, and cybersecurity. And next year, we're going to continue to improve our services and continue to roll out our technology suite as we approach our 50th anniversary in 2026. So looking forward to celebrating that. Our focus as a firm is wealth management and financial planning with retirees and those close to retirement, with businesses and retirement plans, and nonprofits as well, and the executives, professionals, and families that run those organizations. We want to be a resource to help improve the lives of others, and we want to help more people. So just keep that in mind. We promise a no pressure approach, and everyone we talk to walks away with some helpful information. So if you know anyone who would be a good fit, please send them our way, or if you're hearing this for the first time, we look forward to working with you. So we do have a growth program looking to grow by 20 new clients next year. And we do have an advocate program. This is for those that refer us business and for those new clients. And so trying to grow the appreciation family. And going to do a cooking class this year here in the spring, so looking forward to that. As a reminder, there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we always try to consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Okay, so with that, let's get started here. 2024 has been a wild year. Interesting dynamics for investors, market volatility, political unrest, fighting, interest rate changes, more inflation, albeit at a lower rate, and a very contentious presidential election, which has now come to an end. So, how have equity markets performed? It's been a good year. Multiple highs in the stock market, so the companies continue to grow that we're investing in, and things have been. It's been a good year for an investor. But there are some concerns, right? There's the direction of inflation. What's going to happen? We'll get into some of that in a little bit. Interest rate changes, recession concern, geopolitical unrest, and certainly the presidential election. So these are factors that could be, have a major impact on our economy and our business. So just things to be mindful of. The inflation rate has dropped a little bit. It is significantly down. In August, it was 2.5%, and significantly down from the 2022 highs. But it does look a little bit, it has come down a lot. So the most recent number, not continuing to come down, so that'll have an effect on the Federal Reserve here. On November 7th, recently, the Federal Reserve decided to lower their interest rate range down 1/4 of a percentage point. So as you can see here, we are progressing here on the path to lowering rates. So we'll see what happens in moving forward. Although inflation has shown signs of slowing and interest rates have been reduced, Fed officials said in their policy statement that they were giving themselves time to assess how the economy was reacting. They're watching key indicators, and they're going to assess what's going to happen with the next Federal Reserve decision in December. Recession fears or a decrease in economic activity are always concerning. However, many analysts think we're out of the woods for a recession at this time. There are still some others that think we could see recession. So it's not does not appear to be imminent right now, but anything can change. The economy and jobs are still showing that their numbers are pretty good, but that doesn't mean the coast is clear. So regardless of whether or if we could see a recession, the likelihood of it being very severe is pretty low. There's a lot of geopolitical unrest. Many issues, including the ongoing war between Russia and Ukraine. Now there's North Korean fighters in Russia fighting in Ukraine, fighting against the Ukrainians. So it's become certainly a regional conflict there, coupled with the Middle East. That is also becoming a regional conflict. So things look fairly contained at this stage, but there are other countries getting involved, and so equity markets do not like the uncertainty this brings. So we'll continue to keep an eye on this. The presidential election. So not to get political here, but it's been an election year. We'll have a new president next year, and one thing to consider here, it'd be safe to say that this election season intensified emotions and left many investors uncertain of how the result could impact equity markets and their investments and their lives, right? But history has shown that equities, at least, are nonpartisan. Historically, equity markets have been more concerned about the end of an election than really who won it. Their performance is more closely linked to company earnings and overall corporate health than to political outcomes. Now, certainly, the presidential candidate can affect those things, but there's often a lag effect, and equities are nonpartisan. This election, have left there's been a lot of emotions, either optimistic or pessimistic about the coming years. Major events can test the confidence of investors, tempting them to make emotional moves in their financial plans. Making investment decisions solely based on the election is not recommended. History has proved that a well-balanced, diversified, and long-term focused plan, well diversified, eliminates emotion in the best interest of any investor. Seasoned investors adjust their holdings based on their unique circumstances they are facing and the results they're looking to accomplish instead of current events or short-term fluctuations. Recent history has shown us to expect the unexpected. Regardless of who is sitting in the Oval Office or in the House or Senate, we want our clients to have a plan that can weather a variety of economic scenarios that could occur in the coming years and beyond. So let's take a look at this chart here. This just kind of shows you, we currently have a Democrat in office now, and there will be a Republican in office starting next year. And you can see the history of 1 year after Election Day, how the market has performed. So generally really positive, with the exception of the Republican president in the year 2000, which coincided with the recession around the tech crash there. So, overall positive trends there. And if you look at a long-term track, these are from, we have a lot of this election data is from Capital Group, American Funds. So, thank you to them for providing a lot of this. It's really cut from their from information they put out. So we're thankful to them for putting this out there and letting us use it. We have here, you can just kind of see over time. The blue being the Democrats, the red being the Republicans, kind of where we are and what we can expect. And, the market has grown higher. There have been periods of time where there have been, flat or declines, but the overall trend is very positive, as you can see here, right? This chart is an interesting chart, and it goes through the different sort of returns that we've seen under various situations. So with a unified government being the best, and that's what it's looking like. It looks like Republicans are going to control the Oval Office, the House, and the Senate. And so that has generally, not just for Republicans, but for unified governments in general, provided the best returns. So that is a positive indicator here for the future, the next 2 years at least, right? All right, so let's kind of dig into these election issues. So, this is again data from Capital Group, so we're just going through some of this information. But Trump's key policy issues: tax cuts, higher tariffs, immigration curbs, and they can come really fast. So this cycle, I think he's going to move a lot quicker than he did last one, so we'll just have to see how that plays out. The removal of political uncertainty has been a positive. It's been a cloud hanging over the U.S. for more than a year, so one positive certainly is that election results will not be challenged. Everyone can remember the last election and what happened after that, and it was not a good situation, so at least we'll have some stability in that regard. Again, we've avoided a legitimacy crisis here. The election was a surprise to many, right? And the key factors looks like it was inflation, immigration, and national security. Republicans have regained the Senate and the House, so there will be some momentum to push through these policy initiatives. Now, just because the Republicans control the Senate and the House doesn't mean that everyone's going to vote along with the president. There has to be certainly everyone has to agree, and that's not always the case. So, for some of those more contentious issues, there may be some pushback, and the president may not be able to get through to accomplish the things that he's looking to do. The regulatory agencies likely will be rolling back some of the Biden-era rules and implement a more business-friendly approach. So that's generally favorable for the businesses and the stock market. Going to work with issues related to housing, domestic energy production, and promotion of digital assets. So this has been the first really kind of pro-cryptocurrency president. So that's interesting. And all this is we'll see how it all plays out. A lot of this stuff may already be baked into the asset prices as of the recording now, but future will bear that out. Sustainable finance, climate change initiatives, alternative energy projects are probably going to come under scrutiny. So just things to consider. The U.S. economy, is in good shape, right? He inherited a pretty good economy. The working folks, the folks that are the lower spectrum of the income range, their incomes have not, in general, kept up with the pace of inflation. So certainly on the lower end of the wage earner workforce, there's a lot of consternation there. Anyone who's owned assets, housing, company stock, have done pretty well over these last few years because they've been really good inflation hedges. Those without assets, the folks with fewer assets have not done as well. We expect a fiscal package with the goal of fueling a pro-growth outlook, and that's going to hopefully bring higher growth, albeit with likely inflation and higher interest rates. So, we've just been battling inflation. Doesn't mean that growth equals inflation by any means, but there are some of the objectives of the Oval Office that may result in some inflation. So the combined pro-growth, deregulation, and public spending will likely, according to American Funds, Capital Group, likely offset the drag of higher tariffs and geopolitical uncertainty. That would be helpful. The tariffs are an interesting topic. I'm not a huge proponent of them. As a trade economist, but they can work in certain situations. The problem becomes a trade war, and then the cost of everything goes up. Couple more points here. Some more potential issues. Tariffs are policy priority, up to 60% on Chinese imported goods. The goal is to promote some onshoring of manufacturing jobs, bring jobs back here. That's the goal there. So we'll see what happens there. The federal funds target rate is 3%. That could go up to 4%. They could kind of target a higher rate. Some of the initiatives introduced by the Biden administration, unlikely to be repealed, but some of those provisions may be clawed back. Stock markets are at a record high. This could be seen as a relief rally, given it was a more decisive election. It's lowered the level of political risk. The market is focused on potential tax cuts, deregulation. So, we could see equities rally further. And the dollar is very strong and is likely to maintain its strength relative to other major currencies, given how resilient the U.S. economy is. Some areas that we're looking at, some areas that Capital Group has put this out. So this is their information again, but helpful to review banks, financials, because of weaker regulation and lower capital requirements. That may help them. Aerospace defense, that's one that maybe increasing potential spending. It's going to be interesting to see what happens with the war in Ukraine and how all that goes. If we're going to just be trying to sell more of our defense goods to other countries, to be determined there. Healthcare companies, on one hand, may be helped by proposed regulation, but on the other hand, lower prices could affect their profits. And it seems like there's been a lot of issues with healthcare companies. A lot of folks are concerned there. And pharmaceutical stocks have declined. Robert Kennedy has come out, against big pharma, big food too. And he will likely have a place in the Oval Office. So that is something that may cause an issue with some of these pharmaceutical companies. So something to be mindful of. Domestic drilling and mining will be encouraged and could be continue to be deregulated. But that will affect the price per barrel, right? That should drop if there's more oil being produced, which would result in a lower profit per barrel or no profit per barrel of oil. So industrials may benefit from companies moving manufacturing back to America. Smaller companies may benefit from a U.S. economy as well, a strong economy. And multinational companies, especially those that trade in China, could face some headwinds from these tariffs. So. The administration may adopt a more assertive stance on trade. They probably will, including tariffs. The budget, the 2017 Tax Cuts and Jobs Bill, that is going to be basically reverted back in 2026. There's going to be change there, and they're even talking about lowering it further from 21% to 15%. So we'll see how that goes. There are some potential strained relations with the U.S. and international partners there, national security, defense, international trade, economic security. Some interesting insights there. On kind of some things to look out for. Tariffs, as we mentioned, potential increased inflation, an exodus of low-cost labor. If the administration does pursue removing a lot of the migrant workers that we have in this country, the cost of things will be cost of construct. A lot of places where those folks work, a lot of construction trades, them not being there, that may cause some inflation and some other challenges. So there's just things to look out for. Federal Reserve, potential loss of independence there. Lower taxes without spending cuts or significant economic growth would increase the deficit. And then, he's a wild card, right? So sometimes you don't know what you're going to get. So that's just that uncertainty there. And, midterms in 2026. So, control of Congress could shift back. It does often if, the party that is in control is not as efficient or doesn't have the sorts of things that the American people want. They can be voted out. So that's coming up just in 2 years. So, all right. So moving kind of forward here, as financial professionals, we try to provide proactive, long-term planning for our clients. No one has a crystal ball, but historically, the fourth quarter of the year is a good one. This chart shows 70 years, includes a very difficult fourth quarters, including October of '87 when the market collapsed and had its single worst day in history. when studying these returns, it's a good quarter. So as we head into the year, we'll keep a watchful eye on equity markets. It reinforces our thought that when it comes to equities, we believe long-term investing is a great strategy. That does not mean that you need to be fully invested. You need to have a well-diversified long-term strategy. As you can see from another view, investors who focus on a long-term strategy are rewarded with significant returns. Ups and downs are part of the investment experience, but longer-term time frames have shown a healthy upward path. It's been an interesting year, 2024. We stand by our mantra of proceed with caution. Remember, we'll be watching all areas of the economy we feel may affect our clients, and we're here for you with any concerns that you may have. So we'd like to remind you of these 4 things that can help us approach your investments with discipline and focused direction. Your risk tolerance or appetite. By this we mean how much risk can you take, or better yet, how much can you afford to take? Your time horizon, or the amount of time you want to be invested in any situation, which can help you determine your entry and exit points, not to time the market, but you want to make sure you have enough cash to maintain your lifestyle. You want to make sure you have enough cash to spend on those major purchases you may be making, or maybe there's some potential health challenges coming up. So some folks may need quite a bit of cash on the sidelines. Some folks may need relatively less cash. Your behavior, market volatility is a part of the investing experience. This can create anxiety and stress when volatility occurs. Do you know how well you can emotionally endure the potential ups and downs of your investments? And your overall strategy. Are you looking at something that doesn't quite fit with your overall strategy? Perhaps the media is influencing you to make a rash or impulsive decision on your investments. We want your holdings to be congruent with your overall strategy. Panic can create more risk and potentially cause setbacks in your goals. Our main goal is to stay focused on your overall strategy. Warren Buffett said, successful investing takes time, discipline, and patience. Here are some of the key items we hope for you to take away from our equity market review. Caution is still the principal notion for investors. Inflation, while slowing down, continues to be a concern, and it may increase in the future potentially with some of the new administration. Interest rates look like they may continue to fall. Looks like the next Fed meeting will be a cut. So we'll see how that continues there. A recession is still a possibility. The U.S. is one of the most healthy economies in the world. It's kind of the shining star, the healthiest large economy right now. And long-term investing is a key strategy with equity markets. But you need to be diversified into a variety of different things over a market cycle. Don't just focus on the shining stars of the last year. What does well one year typically may not do well the next. So, and as always, we're here to help you. So let's shift to tax planning. Okay, we believe that taking a proactive approach to your tax planning instead of a reactive approach could produce better results. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after year end. Now, most tax preparer folks that prepare your taxes, they're more of a, preparing your taxes. And so, we work with a lot of really good CPAs, and they are over a lot of times overworked, and they are doing really good. The ones we work with are phenomenal, and they really do a lot of tax planning as well. So we really work closely with them. There's a lot of tax folks out there that are just really kind of filing the taxes. They see what you got, and that's what they send to the IRS. So, our strategy is to be proactive, not reactive. Everyone's situation is different. Everyone's situation needs to be considered. We find that taxpayers are in one of 3 major categories of federal tax brackets. The first 2 brackets, 10 and 12%, are the lowest brackets. These are where you have the most flexibility. Now, maybe you're not in that bracket now, right? But there may come a time when your income's low and you can be in that bracket for a period of time. So something to think about, that in the future you may fall into a different bracket as well. Then we have the ones who should think about calculating the tax impact of their decisions. Really, the tax impact of your decisions need to be calculated at any point in time, because if you're in those lower brackets, you may have to stay in those brackets to achieve a couple of things. And then you got the higher brackets, which are the most tax sensitive, just because they're paying the most taxes. But again, that lower bracket chart can also be tax sensitive as well, because there are some benefits that are available that are only available to those folks in the lower brackets. So we're always thinking about taxes and their impact immediately short term over the long term, right? It's very important to think about those taxes. Now, long term can be a question mark, and I like to do kind of 3 to 5 year tax planning, but a lot of our software goes out 50 years. 50-year tax projection is laughable, right? It's not going to turn out that way, but it can give you a good idea of roughly saying, okay, well, when I retire in 10 years, probably have a lower bracket then than I do now, depending on how you take your income. Not everyone does. You have to be strategic about it, but could. That's how our planning works. So anyway, it's helpful. And then, when you get older and you start having to take your required minimum distributions, then your tax rates will go up. So for 2024, there are 7 tax rates from 10 to 37%. Under current law, this will automatically phase out on January 1, 2026. I can guarantee you it's going to be different. So probably not going to phase out. It's probably not going to stay the way it is. It's probably not going to go back to the way it was. It'll probably be some hybrid between the two. Standard deductions, $29,200 for married couples filing jointly and surviving spouses. Now, if you're a little bit older, you have a higher one, but that's basically, you have to have close to $30,000 of deductions before you get any benefit from itemizing. So folks are rarely itemizing. The old rule was to accelerate deductions. The new rule is to time them or plan them out. As an example, if you give away $10,000 a year to charities, maybe it may make sense to give $20,000 every 2 years away. That way you can potentially itemize every other year. Long-term capital gains rates, 0%, which is up to $94,000 a year. That's for a married filing jointly couple. That's a good healthy number there. Then 15% and 20%. So as a part of year-end tax planning strategy, it can be helpful for taxpayers to review tax gains and loss harvesting. So, maybe it's a good time to sell, right? So we've been raising some cash for some folks now, selling those assets that have appreciated the most, and now may be a good time to do that. And then tax loss harvesting, not a whole lot of loss harvesting going on this year, but most years there's something that's down and we try to sell at a loss, but this year has been tricky to find that, which is a good thing, right? You want your assets to go up. Harvesting capital losses is a strategy that has a taxpayer selling assets that are at a loss to offset capital gains. This is a tax deferral strategy that could be valuable. You're able to use $3,000 of capital loss above capital gains to offset ordinary income every year. If you're married filing jointly, it's $1,500. Married filing separately or single. So capital gain harvesting means you're taking capital gains and paying taxes in the current year. So when you're thinking about long-term gain for tax purposes, although the tax is paid at a lower rate, it's paid sooner. So this can be kind of a nice strategy to do. For those who are not fully retired, remember to review your year-end contribution planning. You have to have earned income to be able to contribute to an IRA or a Roth IRA, but here are the limits for this year. So $7,000 or $8,000 if you're over 50, $23,000 for the 401k, $7,500 if you're over 50 in the 401k. So there's a lot of potential savings you can do, and it's not too late. If you're talking about your 401k, the timing is running out. So you want to increase that contribution, get it to 90% before the end of the year. Max it out. So if you're between jobs, just be careful with that, because you may be over the limit, because if the systems that are used to track that have changed for you. So, but for most people, take advantage of this. For some people with IRAs that have not been taxed, a partial or full Roth IRA conversion could be something to consider. Some benefits from Roth IRA conversions include lower overall taxable income. Roth IRAs enjoy tax-free compounding. They have no RMDs, no required minimum distributions, and they allow for tax-free withdrawals for beneficiaries. They're not for everyone, but if you would like to explore one, please see us or your tax professional, right? But we can help model all that for you. We always like to run ideas by the tax people, just because, at the end of the day, they're the ones signing the returns, and We want to make sure they're on board with everything, and they're the experts in that area. But as far as it's integrating to your investment strategy, the Roth IRA conversions, that's something we do a lot with. But always a good idea to run it by your CPA as well. All right, so as a result of the Secure Act, family tax bracket management is a critical area for those with untaxed retirement assets to explore. One of your choices is always to leave everything the way it is, right? If you're in a higher marginal bracket than your beneficiaries, then it may make sense to let them take distributions after your death in their bracket rather than in yours. However, if your beneficiaries are in a higher marginal tax bracket, then it may make sense to take a distribution in your tax bracket before death and then convert these accounts to Roth IRAs and leave your beneficiaries an account that still must be taken out in 10 years, but can grow tax-free. An annual step to consider is to review your marginal tax rate and your beneficiaries' marginal tax rates every year. Okay? So you gotta do that math. College savings plans also can bring tax efficiencies. Let us know if you want to talk about that. The 529 has had some recent changes that basically mean $35,000 of that can go into a Roth IRA, if not used for educational expenses. So it's nice. And you can also use it for private school if you want to, but you do need to let that grow over time. It's the growth that's tax-free. So let's talk about annual gifting. The gift tax exclusion for 2024 is $18,000 per donee. So what that means is that as an example, each parent can gift each child $18,000. Not that you have to, but you can always gift more than that, but you have to file a gift tax return. No taxes are due when you file a gift tax return, but you still got to file it. Another way you can help someone is you can pay directly for medical or education expenses without incurring any kind of gift tax. So there are a lot of ways kind of around this, but something to think about. These numbers, this is the estate planning. So for those of you with larger estates, a wealth transfer planning item to think about is the exemption amounts for gift, estate, and generation skipping taxes. It's currently just over $13 million, or $27 million for married couples. Any amount over that is subject to 40% federal taxes. There is a big planning window to take advantage of. Now, that's going to drop in 2026. However, I'll say that this is something that will probably, it's currently law that it will change to $7 million, but who knows what's going to happen after the election. So if you're in this category, I would feel more safer now that you're not going to see a significant reduction. There were some numbers floated around that sunset, was sunset in 2026 to $7 million. There were some folks talking about a $3.5 million number. So obviously, a lot more folks with $3.5 million than $13 million, especially, in our market. Gosh, there's $1 million homes everywhere. It's wild. So it's certainly a lower bar, but there's certainly not as many families that have $13 million. So if you have a large estate, this is something we work with folks on all the time. So please call us. We're happy to discuss it with you. So qualified charitable distributions, a good strategy for retirement savers. Basically, required minimum distributions were changed to 73. Now, they are 75 for some people, but for folks taking it now, it's 73. Qualified charitable distributions are allowed at 70.5. But basically, most folks are using this if you gift to charity every year, especially if you take the standard deductions. So let's say you don't have any other itemized expenses. You got $5,000 you gift to the church every year. Well, and you got $25,000 you got to take from your IRAs, but you don't really need that money. So what a lot of folks do is they'll have us write a check to their church for $5,000 from the IRA, therefore reducing the amount they have to receive as taxable income. So they avoid paying tax on the $5,000, but then they just gift that to the church. Otherwise, they wouldn't have gotten any tax benefit from the $5,000 gift to the church. So it's a really nice way to give to charity, even if you're filing the standard deduction as most are. So tax law changes. There are changes coming up. Individual income rates are going to change. The estate tax exclusions are going to return to pre-2018 levels. SALT cap will disappear. Child care tax credit is going to go down. AMT will revert back. I think a lot of the stuff's on the table now. So this is the current law, but it will likely change next year. We'll continue to keep you abreast of that. And so here's just some different brackets. The top one is now 37%. That was supposed to go back to 39.6. We'll see what happens. It's going to change the landscape on taxes for sure. All right, so and I think a lot of the stuff, it's going to change. So we'll continue to keep you abreast of it. But in this example, going back to the old tax rates that are slated to come in 2026, a couple with $175,000 of income could go from the 22% bracket to the 28% bracket. So it was a fairly considerable tax savings for those folks, really earning a lot of different kinds of income. It's interesting to see the different folks that are affected positively or negatively by the tax changes. But certainly for these two folks, $175,000, $350,000, pretty significant tax increases. So we'll keep you abreast of that, right? A proactive approach to tax planning is much better than a reactive one. It's going to produce better results. One of our goals is to keep clients updated when tax laws change so they can proactively plan. If you'd like to discuss how these sunsetting rules or any tax law changes may affect your situation, please contact us. We'll be happy to assess your unique financial situation. So what can you expect from us? Regular review of changes that will affect you. Regular communication, more frequent discussions, review of economic, tax, estate, investment issues for our clients. We'll be offering more of these workshops in person and online, so continue to look out for them. We send out great content with great regularity, roughly once a month, via email and snail mail. So if you want to be added to our list, just let us know. Let us know. We'll if you have a friend who you think may find value, just let us know. We'd be happy to add them to the list. And again, no pressure for them to work with us. Not everyone's a good fit anyway, but just nice to spread that knowledge, and it's great to spread our name. So please share this with others if you find it valuable. Thank you so much. Your health and well-being is always our highest priority, and we're not getting any younger, so make sure you go out there and seize the day, enjoy life, and I just thank you so much for your time. Have a wonderful rest of the day, and we'll talk to you soon.